So, our mission today is to really unpack the latest Q3 2025 update. We need to figure out what's actually going on here because, when you first look at it, this update presents this fascinating strategic puzzle. On one hand, you've got record high delivery numbers, record free cash flow. I mean, all the signs that the operational side is just humming along perfectly. But then at the same time, you see this really sharp decline in operating income and profit margins. So, we have to understand this paradox, right? How can things be going so well operationally, yet financially it looks like there's, well, significant pressure.
Yeah, it really is the classic spend now, maybe profit big later strategy, just laid out right there in the financials. What this deep dive will show you, I think, is that the margin pressure isn't really a sign that operations are failing. It's actually the immediate cost of a really aggressive global expansion plan. They're pouring huge amounts of money right now into building the foundation for this AI-driven future. And that's across, next-gen energy, future transport like the cybercab, and crucially robotics. We're basically watching a manufacturing giant try to morph into a full-stack AI company, and, well, that kind of transformation doesn't come cheap.
Okay, right. So let's unpack that. Maybe we should start with the numbers that looked, well, fantastic. We have to acknowledge the scale first because that makes the margin story even more perplexing. So total revenues hit $28.1 billion. That's a pretty solid 12% increase year over year, or YoY. And deliveries, 497,099 vehicles globally, another record, up 7% YoY. But, maybe the most critical number for investors, even more than deliveries, is the cash generation, the velocity of that cash.
Absolutely. The cash generation was incredibly efficient this quarter. They pulled in $6.2 billion in operating cash flow, which then resulted in a record free cash flow of nearly $4.0 billion. Just think about that for a second. A 46% increase year over year in actual cash, they have free. It's huge. And you see that operational efficiency kind of everywhere you look. Their total cash and investments up by almost $5 billion in just 3 months. They're sitting on $41.6 billion now. And my favorite metric here, actually, is inventory. They managed to get global vehicle inventory down to just 10 days of supply. That's running incredibly lean.
10 days. Wow.
Right?
That's practically building them to order. It shows world-class operations, definitely.
So, okay, here's the tough question then. If everything's running so smoothly on the operations side, where did the actual profit go?
Right. This is the other side of the coin. This is the price tag for that future investment we talked about. Despite the revenue growth, GAAP operating income actually decreased 40% year over year, landed at $1.6 billion. And that dragged the operating margin way down to just 5.8%.
5.8%. Wow. Okay, just to put that into perspective for everyone listening, that's a drop of 501 basis points compared to last year. So for those who don't, live and breathe spreadsheets, 501 basis points means they lost over 5 full percentage points in profit on every single dollar of revenue compared to Q3 last year. That's a really fast and dramatic drop.
It is. It's significant. But we have to look at why it dropped.
Right.
The main driver, according to their own report, was a huge increase in operating expenses.
Yeah.
We're talking big jumps in SG&A, that's selling, general, and administrative costs, plus massive R&D spending, specifically flagged for AI and these next-generation product initiatives. They're basically putting a ton of investment up front that they hope will pay off over the next decade or more.
Okay, so let me ask this. If we could somehow magically strip out all that spending on AI and maybe the early cybercab R&D, would the core profit margin on making and selling the current cars look significantly different? Because, if the core business itself is faltering, that's one narrative. But if they're just investing like crazy for the future, that's a completely different story, isn't it?
It's absolutely the second one. The notes clearly state this spending surge included major investments in expanding their AI compute, they call it Cortex, and the initial work on building out these new, dedicated vehicle production lines. They also mentioned some other pressures like lower revenue from regulatory credits, which they usually get, and a higher average cost per vehicle. That's down to things like tariffs, the mix of models they sold, and maybe lower absorption of fixed costs for certain models. But the core strategy seems clear. Intentionally push for volume, spend heavily on CapEx and R&D, even if it means taking a hit on the immediate margin. They're prioritizing market share and future monetization over, say, short-term earnings per share.
Right, that makes sense. And that leads us really nicely into the automotive strategy itself, which, as you said, seems to be all about volume, market share, shifting towards maybe strategic affordability. trying to really maximize the use of the factories they've already built all over the world. Like in the US market, right? They launched these new standard versions of the Model 3 and Model Y. Both offer over 300 miles of range, starting at what, $36,999 and $39,990. That felt very tactical, almost like a direct answer to the US EV tax credit expiring, making sure that affordability and therefore demand didn't just fall off a cliff.
But isn't there a risk there? I mean, cutting prices on your main products right after a tax credit disappears, doesn't that just sort of confirm the market wasn't quite ready to pay the full premium without the subsidy? You could end up, trading your customers to just wait around for the next price cut. That seems like the strategic gamble with this big volume push.
That's the balancing act, isn't it? I suppose the argument is that the volume gives them crucial data, massive scale, and helps absorb those huge fixed factory costs, which they absolutely need if they ever want to hit the kind of price point needed for, say, a future robotaxi fleet. So maybe the lower margin today is just the necessary cost of keeping those global factory lines running flat out.
And this affordability push, it's not just about price. It has this interesting cultural angle, too. Look at the Asia-Pacific market, APAC. They launched the Model YL in China. That L means longer wheelbase. It gives you 3 rows, 6 seats. That's a really smart nod to local preferences, where families often travel together across generation.
Right. So they didn't just drop the standard American version there.
Exactly. They engineered a specific variant for that market. And maybe that's part of why South Korea is now their 3rd largest market globally. They're segmenting really effectively.
Meanwhile, Europe's still a major player. The Model Y was apparently the best-selling vehicle overall year-to-date in places like Norway, Switzerland, Iceland. And Gigafactory Berlin is now churning out the Model Y performance variant, too. So yeah, it looks like they're squeezing every bit of efficiency out of today's capacity, like Shanghai running at over 950,000 cars a year before they commit to building entirely new lines for the current models.
Right. Maximize today's output while simultaneously building tomorrow's factories. We heard construction for the Cybercab is kicked off in Texas, and the Tesla semi-production line construction is apparently underway in Nevada now, too. It seems like a measured kind of dual-track approach. Optimize what you have, but aggressively build the facilities for the autonomous stuff coming in 2026 and beyond.
Okay, so we've kind of established that the margin squeeze in vehicles seems deliberate, designed to drive volume for this future AI fleet idea. But if the cars are where the margin pressure is, where's the unexpected profit coming from right now? And it's actually not transport at all, is it? It's this huge surge happening in their energy storage and services division.
Yeah, that's the surprise element this quarter. That segment is now a genuine profit engine. It's not just a side hustle anymore.
The scale is pretty incredible. Q3 saw record energy storage deployments, 12.5 gigawatt hours, or GWH. That's an 81% increase year over year. Massive growth.
And the money it's bringing in is substantial, too. Gross profit for energy generation and storage hit a record $1.1 billion. That scale is being driven by record Powerwall deployments for homes, but also, critically, these massive utility-scale battery projects.
And the innovation there seems pretty striking, too. They unveiled something called the Mega Block, which sounds like a next-gen industrial storage product.
Yes, exactly. The Mega Block sounds like it's designed for speed.
Yeah.
It's pre-engineered, apparently integrates 4 of their big Megapack 3 batteries into one simplified unit. The idea is to drastically cut down the time it takes to deploy these huge utility-scale battery farms. This is the kind of industrial scale they're aiming for. They mentioned Megapack 3 volume production is slated for 2026 out of a new mega factory in Houston, targeting up to 50 gigawatts per year of capacity eventually.
Yep.
Huge numbers.
And the charging infrastructure is keeping pace too, right? They added over 3,500 new Supercharger stalls globally. That's about 18% network growth YoY. But the really big news on the charging front seemed to be the launch of these new V4 Supercharger cabinets.
Yeah, let's pause on that V4 cabinet for a second, because the specs are pretty wild. They apparently feature triple the power density of the old V3 cabinets, which allows, get this, 500 kilowatt charging for regular passenger cars. That's incredibly fast enough to pretty much eliminate range anxiety for most trips. But think about the logistics angle. It also enables 1,200 kilowatt charging capability for the Tesla semi-truck.
1.2 megawatts. Wow, that changes the game for electric trucking, doesn't it?
Exactly. I mean, charging time is the absolute killer for fleet operators wanting to go electric. 1,200 kilowatts could make a massive difference to how much time those trucks spend charging versus driving. So this isn't just building more chargers. It feels like a strategic move to lock in the commercial transport sector for when the semi really starts rolling out.
What's so fascinating, though, is how every single one of these physical things we're talking about, from the cheaper Model 3 to the mega-fast V4 supercharger to the industrial mega-block battery, it seems like the company views all of it as just the necessary hardware foundation for future AI-powered software services. Which brings us back to the core AI strategy, which is really the big cost driver we identified earlier.
Right. The AI strategy connects absolutely everything. It's all part of that long-term vision they laid out. Master Plan Part 4, I think they called it, focused on achieving sustainable abundance through AI. So every car is designed with autonomy in mind. Every energy product like the Powerwall or Megapack is designed to be optimized by software things like VPP or AutoBidder.
Okay, hang on. We should probably define those quickly for listeners. VPP and AutoBidder, what are they exactly?
Oh, good point. Yeah. They're basically the software brains and potential money makers for the energy side. VPP stands for Virtual Power Plant. It lets thousands of home batteries, like Powerwalls, act together as one big power plant, selling stored energy back to the grid when demand and prices are high. AutoBidder does basically the same thing, but for the huge utility-scale batteries like the Megapacks, they're software platforms that automatically manage and trade stored energy to maximize revenue. The hardware enables the software, and the software generates potentially high-margin income.
Got it. That makes perfect sense. So the hardware is the enabler, the software is the service, and to build the core AI that runs all these systems and the autonomous cars, they're spending colossal amounts on computing power. They announced that deal with Samsung, right? To make advanced AI chips for inference and training manufactured right here in the US.
Yep. And their own internal AI training cluster, Cortex, has apparently ballooned now to 81,000 H100 equivalent GPUs. That's a massive amount of AI training horsepower. And that kind of expenditure is directly responsible for a huge piece of that operating expense spike we talked about earlier. They're literally building the digital brain needed for global full autonomy.
And we're starting to see the software results of that investment trickle down, right? Like the deployment of FSD Supervised version 14. They said it brings a large chunk of the actual robotaxi software model to consumer cars now. Things like handling tricky situations better, avoiding road debris, yielding to emergency vehicles. Those sound like key steps toward true hands-off driving.
And the actual robotaxi service itself is pushing forward too. They launched it in the Bay Area, they've expanded the fleet in the service area down in Austin, and apparently the wait list to try it is now open to basically everyone in the US and Canada through the iOS app. So they're gathering that crucial real-world data, testing the service model, getting ready for when the dedicated Cybercab vehicle actually ramps up in 2026.
And then you have supporting software features popping up, like Grok, that new AI assistant showing up in cars in North America. And that fun little example of ecosystem integration, being able to order food from your car's touchscreen before you even pull up to the Tesla diner in LA. It really paints a picture of an integrated system where the car is just one node.
And just to circle back finally to those future hardware timelines, they reiterated Cybercab, Tesla Semi, and the big Megapack 3 are all officially on schedule for volume production starting in 2026. But the really, really long-term bet, the one that could fundamentally change their cost structure, is Optimus, the humanoid robot.
Right, Optimus. Why does the timeline for a robot matter for this financial deep dive right now?
Because, well, if you believe their vision, Optimus is positioned as the ultimate tool for reducing long-term operational costs. It's intended to eventually replace a significant amount of human labor in manufacturing and potentially other areas. If they can pull that off, Optimus could become the single biggest long-term cost reducer imaginable. Which is why, even while vehicle margins are under pressure today, they're actively installing the first-generation production lines for Optimus right now. It's part of that upfront investment.
Okay, so wrapping up the Q3 story then, we have this clear duality, this tension. On one side, record-breaking performance in hardware making and deploying cars and batteries at an incredible scale. But coupled with that, you have this really aggressive upfront spending spree on AI compute, on R&D, and on physically building the factories for the next generation of products like Cybercab and Optimus. The current low margin, that 5.8%, seems like the calculated price they're willing to pay for that future position.
Yeah, it really feels like the necessary cost of scaling up and transitioning, moving from being just a very successful car company to becoming this full stack AI and software player focused across mobility, energy, and robotics. I mean, they stated pretty explicitly themselves they expect, and I'm quoting here, our hardware-related profits to be accompanied by an acceleration of AI, software, and fleet-based profits.
Which brings us to the final provocative thought for you, the listener, to chew on after digging into all this. What will that financial statement actually look like when, or maybe if, the profits from those future, presumably high-margin AI services finally start to outweigh the massive ongoing costs of developing the AI itself and building all the hardware to run it? The robo-taxi fleet income, the auto-bidder energy trading, maybe even Optimus services down the line. When that crossover point hits, what will that acceleration they talk about actually look like for the entire business model? That, I think, is the real inflection point everyone's watching for.